Good afternoon and welcome to Money Tips, the property edition. This is Charles Kelly, and over the last few weeks I have been talking about something called equity release. This is where people are releasing equity from their properties to do all sorts of things. You can't miss it. There's always adverts on telly pushing this product, and I thought I wanted to bring in an expert. So today I've got special guests with me, James Blair, good buddy of mine, and he is an equity release advisor. So he's registered and regulated to advise on equity release. So welcome to you, James. How are you doing today?
Thanks very much, Charles. Yeah, I'm very good. Actually, it's an enjoyable Friday afternoon here. So, yeah,
Great.
Yeah.
Now, we should say from the start, I'm sure James might say this, but this is an educational video. James is not going to give you specific advice today, right, James? Is that right?
That's correct. What I'm going to do is just cover the basics of equity release. I've got a little agenda here. And what we'll do is just go through the current state of the market and some of the protections of equity release and the uses. And then we'll basically look at a case study, an average size case study, and the costs that are associated with equity release. And then we'll just have a conclusion, and then you can finish off with the legal bits, I suppose.
Okay, great. I mean, just to, you got to think, a lot of people may never have heard this. What exactly is equity release? Okay,
well, equity release is really where you release funds from your house. That's as simple as it is. It's basically, there's two sides to equity release. There's the lifetime mortgage side, which makes up 99% of the market, which really is a mortgage against your house, where you have the option to make payments or no payments against the house. Whenever you die, that loan will need to be repaid either when you pass away or move into long-term care, usually from the sale of the house. The house gets sold, the equity release then gets repaid, or the lifetime mortgage gets repaid. Once it's repaid, then whatever money is left in the estate is divided up as per the will. And the other side of equity release is a thing called a home reversion plan. A home reversion plan has been probably is the oldest form of equity release. And that is basically where you sell some or all of your house to a home reversion company. There's very few in the market at the present time. And in all my experience of 30 years in equity release, I've actually only ever done one home reversion plan. And it's not mainstream anymore at all. What we see now with equity release is that it's becoming more and more mainstream all the time. People are looking at it really as part of their financial planning and as part of their retirement options. That's basically what a lot of people are doing, are using it for now. That's it.
Okay, I think that's a great explanation. So I'll let you carry on to the next stage of your agenda then.
Yeah, the current state of the market is as you probably think, as you probably know, the whole world is basically being turned upside down, and the cost of living crisis is basically upon us, and we're going to have paying a lot more for our fuel and energy. And it's probably in times like this that equity release really comes into its own, because people in the past have used equity release really to supplement their income. You know, you see the advertisements on the television, and it's people going on their holidays and elderly grey-haired people like myself having a little dance and all that sort of stuff. Yes, equity release is used for that, right? But in all the times that I have done equity release, the majority of times, the biggest reason for doing equity release is really home improvements. That's one. And number two is to help the children, because a lot of people say, well, look, James, there's no point in me dropping down dead, having this big house, and then my kids getting the benefit of it. A lot of them will say, well, okay, I would like to give them something now because they need the money now. Like, we're based in the southeast of England, and you know, my daughter is renting a house, or not even a house, she's renting a room, and I think she's paying something like £1,200 a month to rent a room. You know what I mean? So the people, you say, well, okay, well, why don't you do some equity release and then release some funds and you know, give them something a head start. And that's really where the market is now. The average, there's actually, I was just checking through the Equity Release Council, which I am a member of, and they produce bulletins and different pieces of information all the time. And currently now there's 200 equity release cases completing every day throughout the United Kingdom.
Sorry,
Now,
200 cases every day.
correct. Now, 200 cases doesn't sound like a lot, but when you multiply it by the average size of a release, which is £135,000, that's a lot of money that's basically being put back into the system again. And I don't know if some of your people are taking pensions. So a lot of people they've moved away from annuities because of the low rates and all that sort of stuff, and they're using their pensions to fund their lifestyle, and they're using the drawdown situation where they're drawing funds out of their pension every month. And what's happening now with the stock market basically on the slide, and people drawing money out of their pension, what they're finding is that they're thinking, well, is my pension fund going to run out? Am I going to have sufficient funds when I'm 80 years of age, or whatever the case may be, to sort of have a life? Because it's all right drawing the money out of the pension, but if you're like 60, 65, 70, that age, the chances of you ever basically being able to put any money back into it again is very remote. So it's a thing I refer to it, and you'll see it sometimes in the press, as pounds cost ravaging. And what that does is that basically creates a lot of uncertainty in the market. And then people think, well, okay, then what am I going to do? I've got this house. I probably maybe don't have a mortgage on it. Or if I do, you've probably got a little mortgage on it. Can I use it? And it's just really another financial planning tool. That's really what equity release is. But as I was saying,
sorry, Joe, I was going to say something. A lot of agents are telling me that they're getting first-time buyers now who've got substantial deposits. And I'm assuming a lot of that is coming from these 200 cases a day, because normally a first-time buyer might save 30, 40,000, but when they're coming in with like a £200,000 deposit to buy a £500,000 home, that's probably coming from an equity release.
It is,
or even grandparent. And why not give it to them now rather than wait they might live another 20 years, by which time their child or grandchild has probably done their own thing anyway. So I think it's a great scheme.
Yeah. In the southeast of England, it's the house prices, as you know, probably have gone through the roof here. The average house price where we are around sort of North London, this part of the world, is around about £800,000. That's 700,000-800,000. That's what they pay. Now you can imagine somebody's probably paid off the mortgage. They're in their maybe early 70s, and that's basically where the money's coming from. And what we've seen in the past, it used to be that a lot of the cases were drawdown, where they took out, let's say, they were supplementing the pension. They take out maybe 20 grand. Okay, I would do like a budget plan for them. I would say, well, how much money are you likely to need over the next 3 or 4 years? And they say, well, okay, my pension is this and that, but what I would like to have is maybe an extra, 15,000-20,000 pound a year, so as I can use it on myself. What we're seeing now is that it's basically been flipped on its head. Is that the drawdown is sort of taken secondary, and they are taking the lump sums out, and they generally are for their kids, to basically have that deposit to put down on a house. That's really where the money's coming from.
Well, from my days in financial advice, I never did any of these plans because they were specialist home revisionary, but they were kind of aimed at people that had a big house but didn't have the income and money to sort of heat it. So they were taking out small loans just to supplement their living style. But now it's very different. People are taking out, the sums taken out have changed now. They're quite large sums in some cases, aren't they?
Well, it really depends, right? It's like everything. Whenever I sit down with a prospective client to talk about equity release, what we do first of all is we look at their budget. How much are they spending every month, and then we look at their income. And because what you don't want to do with equity release, and I refer to people, I say, look, you only really, and 90% of the time, you only really get one chance to do equity release. So you don't really want to mess up, nor do you want to spend all the money on day one, because you ain't going to get any more money on day two. It has to be planned. The execution of the equity release has to be planned. And that's why whenever you're actually speaking to an equity release advisor, and any equity release advisor is basically regulated by the Financial Conduct Authority, and we have to follow a process. We can't just sort of rock up and say, okay, yeah, I think it's a good idea, take out 300 grand out of the house, blah, blah, blah. Every penny of that equity release has to be justified. And it has to be justified by the compliance, because all of these cases are going through compliance people, because you're deemed to be a vulnerable individual if you're using equity release anyway. That's part of the That's part of the Equity Release Council. part of the FCA requirements as well. You're deemed to be vulnerable, so everything has to be checked and double checked. And if you don't get it right, well, the compliance guys won't let it through. Anyhow. So it all has to work. And what we don't recommend people do is take money out and stick it in a bank account, because you're paying 4, 5, 6% interest on funds that you're not going to use. That's why the drawdown really comes into its own, because the way the drawdown works is that people say, well, okay, then I need £20,000 now. I might not need any more money for another 3 or 4 years. And they say, well, okay, once you have the drawdown there in place, what you can do is you can take out your initial amount and you'll be charged interest on that initial amount, whatever it is, 4.5%, 5%, whatever the case might be. And whatever is left in reserve, there's no interest charged on what's in the reserve. The reserve is actually, you only pay interest, or interest is only charged on the money when you physically take the money out of the reserve and it's in your bank account.
But it's agreed by the provider that you can come back for this money later on.
Absolutely.
You don't have to go back and reapply.
No,
that's the thing.
It's one cost. One cost does it all. So you get your solicitor's fees, your surveying fees, and our fees, and all the fees that go associated with. You only have to pay them once you go into the drawdown. Once you get into the drawdown,
that makes sense. To do that.
Yeah. But what I say to people, I say just be very careful. Even with the drawdown, because you know what it's like when people get access to money. It's a bit like crack cocaine. They just basically think, and it can go very quickly. So you have to be able to budget, and it's always important when you're thinking about equity release is to discuss it with your family, because they are the people that are really they're going to be the ones that say that their inheritance may be spent, or some of it may be spent by their parents, and they may not be aware of it. So it's important that family members are basically involved in the decision making. That's if they want to be there, because sometimes people say, well, no, I'll make my own decision. But we sort of insist that, you should discuss it with somebody, at least who, the kids are going to benefit, because the last thing we want as well as advisors, and, it's the litigious environment that we're living in now, is to get a letter, after the parent's day, and sort of a complaint to say that, hold on a second, you basically stitched my mother up or father up, and you told them to take out equity release. So we want to be, everything's very, very transparent.
Okay. On the drawdown, I think, though we're wrong, the interest rate you would take on the money you initially take would be at one rate, but it could change by the time you draw down the next bit, or is it the same?
Right. No, it can change. It'll basically, the money that you take out today will be generally fixed, and that will be fixed for whatever length of term the loan is. Okay. If you go back next year, and let's say, for example, you want to draw down another £20,000, then it'll be at whatever the interest rate happens to be then.
Which is likely to be higher according to forecasts and inflation.
Yeah, but it's likely to be higher. But but again, there's no crystal balls here, right? It is likely to be higher, and sometimes people think like that. They think to themselves, well, maybe I should take it all out now, because if interest rates go up next year, we don't encourage that at all.
Right. Okay. Because they're immediately paying interest day one, then, or it's rolling up.
And it's
they don't pay the interest in general, do they? It's rolling up.
No, the interest. There's been changes actually the way that it's governed now, and it used to be the case that the equity release companies were very restrictive, and they wouldn't allow you to, let's say, make repayments against the loan and things like that.
Okay.
They all have to now make, if they're part of the Equity Release Council, and that's the only people that we generally deal with, they all have to allow repayment of the mortgage.
Okay.
And they can pay, a lot of them allow up to 10% repayment of the capital every year. So they can basically, if they think themselves, well, what I really want to do is I just want to take this money out. I've got some money here, and what I do is I want to cover the interest on the loan. A lot of them allow you to do that. So there is no debt build up on the estate. But again, very few of them do it. I mean, realistically, it's gone. They take it out and spend it, and they don't make any repayments on it or anything, because that's just the way I want to do it.
And there is something called Rule of 72, isn't there? Tell me how fast.
Yeah,
the loan
it really
double
depends.
in size.
That's probably the one of the main things I learned when I was at school. Probably the main one I learned was at school was the Rule of 72. So for example, if you have if your interest rate is 4.5% on your mortgage, well, if you divide that into 72, you will know that I'm trying to work this out myself. So it's 72 divided by 4.5 equals 16 years. So if you drew out 135,000, which is basically the average amount of money that people are drawing out now, if you drew that out today, in 16 years' time, that debt would double.
Okay, so go from 135 to 270,000 in 16 years. That's 4.5%.
Correct.
Okay.
So, and what happens is whenever we come round, or whenever any financial advisors speak about it, they always have to have an illustration. That's why the process works, is that it's a meeting at the start. You get your research, you get your discovery, you find out what the people want, what their goals and basically what their goals are, and what they want to do with the money. Then we take it away, we do the research, and then we come up with a product. And before we basically recommend the product, you have to take you through the whole illustration, and it's very transparent. So on the illustrations, it shows exactly how much will be owing at any specific time based on the amount of money that you're going to take out. But again, this is the disadvantages of equity release as well. It has its great advantages because you can do whatever you like with it. The disadvantages of it is that it's compounding, and again, that compounding effect works to the rule of 72. So you know that whatever you're basically going to draw out, and whatever the interest rate is, divided into 72, that's the amount. That's when it's going to double. And that's probably where people get, they get that little intake of breath. I can remember when I was doing equity release, probably in the mid 2000s, and the equity release companies were probably charging 8 or 9%.
Yeah, rates were high.
At that particular time, equity release was the area of last resort.
Right.
Because what you would do, first of all, say, well, look, have you checked it with your family and friends? Can they not lend you some money? Have you been to the bank? Would they lend you some money? Have you looked at maybe remortgaging your house on a normal remortgage, just where you pay the interest, right? Have you looked at a second charge? Have you looked at this? Have you looked at state assistance, and going back and asking the welfare if they can help you? It was an area of last resort, or as I used to refer to it, as a product for single men or bachelors, basically, who never got married. They owned a house, they got to a certain age, could do what they like with the money,
Really?
So,
wow.
Yeah, it didn't really, I used to do a lot for those guys, years ago, but not so much now. It's basically family planning. It is all about help. It tends to be all about helping the family. What we're seeing also is that the areas that it's used for is interest-only mortgages. A lot of small, or not small, but any type of, a lot of business owners, what they were doing is that they would basically be remortgaging their house to maybe put money into the business,
Right.
And what was happening was that the business may be successful, may not have been successful, but they always made enough to cover the mortgage, right? It was enough interest only every month to cover the mortgage. And then what happens is that it comes the day when the mortgage has to be repaid, and there is no endowment in place, there's no pension plan in place, there's no nothing in place. So the lender comes up and they don't say, excuse me, do you remember that couple of £100,000 you borrowed, I don't know, 20 years ago or 15 years ago? Can we have it back now, please? You know? And I've done a few of those for people quite recently, where they're, where the building society is basically looking for the money. So
and they won't extend these mortgages so easily as they used to, right?
They won't extend the mortgages, but I haven't seen any. I haven't really seen any lenders or any building societies take any action, yet.
Really?
What they've done is they've sort of said, well, they put it on the back burner, and they keep saying, well, okay, well, they send people letters every 3 or 4 months, and would you repay this mortgage? But what tends to happen is that people just keep paying the interest on the loans. But when you get to 75 or that sort of age, it's the anxiety and stress of getting these letters through the post every couple of months. You don't
want that. You don't want that.
Because you don't want that, and that's what's basically producing in the market. But as I said before, you can basically use equity release for virtually anything you want. The advantage is it's basically money that's tied up in houses that can be released really for whatever you want, as long as long as you know that it might run out and you're probably only going to get one go at it, you know.
Right, that's interesting. And just to clarify, interest-only mortgages are different from capital and interest payment mortgages, where your payments are going towards paying off your capital. With an interest-only mortgage, you can get to the end of the term and you still owe the same amount of money. All you paid is interest. And then the lender says, as James said, we want the money back. And then you say, well, can we just extend it another 20 years? And they go, no, you can't.
No.
And anyway, they would look at your income at that time. And if you're 70 and you've got no income and you've got a small pension, then maybe won't even give you that same amount of mortgage again. I know someone who had to sell his house because the lender just wanted their money back. It was crazy, really.
Yeah, and you see, you have to be careful as well, because the equity release, although I said it covers the mortgage in Spain, is that some of the people have got larger mortgages than they can physically take out of the house, even with equity release. So that particular scenario, then the house would have to be sold. The way it works is it's just to touch on actually how they do the numbers, right? And it really is to do with age and value of house. Okay, you can do equity release from 55 onwards.
Right, 55.
And what happens is that the lender will allow you to at age 55, they would allow you around about the 25% release. So if your house was worth £100,000, the maximum release then would be 25,000. Okay, at age 55, and then it goes the whole way up to about 80 years of age. The lender will turn around and say, well, okay, then you're 80 years of age. What you can now do is that rather than putting a maximum on at 25%, you tend to see the maximum somewhere around about 50. It's 50% of the value of the house. That is
of your life expectancy, obviously. Yeah, absolutely.
And some of them will offer enhanced terms, which means they may go more. They'll go maybe above the 50, a few, whatever. Okay. And that would be based. Let's say, for example, if you've suffered from some sort of cancer, heart attack, stroke, that type of thing. You know, where your life expectancy is going to be reduced because they know they're probably going to get their money back within certain. And as far as the lenders are concerned, right, they're very cautious, these guys. Like they know they're not stretching themselves, you know, because they're only going up to 50%. You know, they're not going past, they're not going to say 70% or 80% or anything like that. So they're well covered, you know.
Yeah, because they have to cover themselves because the loan is rolling up and accumulating and doubles every. And so they must make sure they can get their money back, even if there's a downturn in the market.
Yeah, absolutely. Yeah. They're not like, and what you've seen is when I was started off in this particular market, like you probably never would have heard of the actual equity release lending companies. You know, they were very small, they were very niche. Right. But now what's happened is that the big insurance companies have taken over the market. You know, the Aviva, Legal and General, Canada Life, More to Life, who are basically part of I think they're a private equity company now, but they're in the marketplace. Pure Retirement, but it's like the Legal and General and Aviva and Canada Life are the big players. And what they basically done was they just bought over small, like any of these large companies, they just bought over smaller players, and they just basically morphed them into Legal and General or Aviva or whoever. You know, so it's a very competitive market because you know I've noticed that the rates now have started to go up. You know,
what are the average rates at the moment?
The average rates are the lowest rate on the market probably is that around 4.5% now. Okay, around about that figure. Okay, and that's where you would be drawn out. Let's say your house was valued at £800,000. Okay. Yeah. If you wanted to take out something like £135,000 and that was it, forget about it. I'm never going to touch it again, and that's all the money I'm ever going to take out of the house. That would be around about 4.5%. Okay. Okay. Whenever you go on to I was referred to it as the bachelor scenario, where the guy's maybe 75, never been married, has a house, £800,000, they would probably lend him up to. On day one, they would say, we'll give you up to about 400,000.
Wow. Yeah? Right.
However, he doesn't need 400,000. He probably only needs 20 grand a year, but he might want to buy a car, flash house, go on holidays, all that type of thing, right?
Yeah, sure.
For you having the reserve and the money, then you're talking around about the 6 to 7% now. on that money. So that initial withdrawal, whatever that initial withdrawal would be around about 6 or 7%.
Okay, so it very much depends on the risk factor, the amount of.
Yeah, the more you apply for, or the more you have in your reserve tank, the higher the interest rate will be. And and as I said before, most of the equity release companies will allow it's all fixed, so you know exactly how much you're going to be paying over how much is going to need to be repaid at any particular time.
So there is an advisor would decide which company is most suitable for each person, right?
Oh, absolutely, we would do that. We wouldn't make any recommendation now. That would all be done once we sit down and go through the discovery, find out what they want to do, what they're looking to do, what their plans are, who they want to do, what they want to do with the money. Are they going to inherit money later on? Are they going to actually move house? Because that can be a problem as well,
Yeah, sure.
Because, it used to be the case where you couldn't actually repay the equity release, but a lot of them are portable. So you can actually take the equity release from one house and put it onto another. And what happens is once you pay back the difference, because what tends to happen is you're going to be moving from a larger house to a smaller house. Okay, you would have increased your age would have increased, so you would be allowed more funds to draw out. However, the house would be worth less, therefore you would actually have to probably repay some of the money back from the sale of the house. Okay. But you wouldn't have to pay any early repayment charges on that.
Okay, great.
There's a couple of protections that I'd like to point out, and these are very important because people worry about these type of things, right? Because number one is that they worry about, well, can I stay in the house forever? Okay, and the answer is yes. As part of the legislation or Equity Release Council safeguards. Okay, if you use one of their lenders, whoever it happens to be, they allow you basically to stay in your house until either you pass away or you move into long-term care. And also, if it's a husband and wife, it is on the survivor, whoever lives the longest. So if one of them passes away, they're not going to come knocking on the door and say, "Excuse me, your husband's passed away. It's now time you moved out because we need to sell the house." It doesn't work like that. As long as both people qualify and are on the application form, then they can stay there for as long as they want. And another factor that sometimes affects not so much the people but their beneficiaries, okay, is that the beneficiaries sometimes get concerned. Well, what happens if house prices collapse and the loan just keeps trundling on and compounding at X amount every month? What happens then? Well, basically what happens then is that whenever the parents pass away, the actual loan will never be worth more than the value of the house. Okay. So for example, if your parents,
no money liability, right?
Correct. If they had £200,000 in the bank and on the equity release on the house was actually, let's say it was 110% the value of the house, they can't come to the beneficiaries looking for the extra 10%.
Okay.
It's a non-recourse loan attached to the house, and that's it.
Okay, and you briefly mentioned long-term care. And what typically happens if people go into long-term care? Let's say, for example, it's the last survivor. If the first person is into long-term care, then the equity release just continues, because the other person is still a survivor living in the house. But when the second person would move into long-term care, that is when the lender would say, well, okay, then we want our money back now. So that particular scenario, the house would then be sold, and whatever would be left over would then go back into the estate of the individual. And again, what would happen then, if they were still alive and still in a nursing home, the nursing home would probably take some of the money. That's the way it would work. But a lot of people, prefer to have care in their own home, so they can use the equity release to pay for care. Of course,
they can, and that means they can stay within the. And that's what whenever we're doing this, there's about 20 or 30 questions we have to ask. Like, why don't you move to a different world or different part of the world where it's cheaper? Why don't you move in with your family? Why don't you take in a lodger? Why don't you do this? Why don't you sell your dog? It's all these different scenarios. And what you tend to find with people is that they've lived there for 20, 30 years. They don't really want to be rushing away to Bournemouth where they don't know anybody, or Brighton, or whatever the case may be. They want to stay with their friends.
Yeah, I've known people say, I'm not leaving this house unless they carry me out in a box, you know, that sort of thing. They're used to it if they've been there so many years, and the stress of moving is terrible as well. But
Like, yeah, the stress is a big thing. Like, there's a couple of radio commentators, and I hear them on. They're always going on about how bad equity release is, and the reason that they're basically saying that is because they've had relatives that probably have wanted to repay the mortgage, right? Because they because everybody wants to nobody wants to carry debt forever. You know, they all want to repay it. But what
yeah,
tends to happen is that it's the compounding, you know, and in the early days of the 7 or 8%, if you borrowed, I don't know, £10,000 to buy a car 20 years ago, you know, that debt would probably be 30 grand now. So you have to be careful. You know, it's not a panacea for everything. You know, we take a good financial advisor to take the people through the numbers and explain to them exactly that it's, again, as I keep referring to it, it's not to be messed with. You know, it is a proper financial planning tool.
I mean, so at the moment, there's a kind of almost like a window of opportunity where interest rates are still low. It's still a good viable deal. And I guess with inflation at 10%, and if you're paying 5% on this mortgage, it's almost like inflation is kind of eating away the value as well in some ways.
It's going to be eating away at the debt.
Yeah.
Because the money that you take out is going to be worth less. But again, that's not a reason to sell it. You know, that would be the Financial Services Authority, the Financial Conduct Authority. You know, that would be like the tail wagging the dog, right? There has to be a financial need for the money, you know?
Okay. And you don't automatically use it. You don't promote it as an inheritance tax plan, although it does save.
It can be used as an inheritance. It's not even so much. Well, it's not even so much used as an inheritance tax plan. What they're doing is they're just like, I want the money today to give to my kids. I want it because they need the money to buy a house, or one of them. Like one of the ones I done recently was where there was a lady that got divorced. The daughter got divorced, and the husband wasn't paying her any money. You know, so she was basically hunting around looking for somewhere to live, pay rent, this, that, and the other, and she had no funds. Like she went to the universal credit people and, you know, say, yeah, you get some money and you don't do this, you won't qualify for that. And again, a very stressful situation. So what the mother and father wanted to do, they wanted to really help their daughter as quickly as possible. So they said, well, okay, then what we'll do is we'll do some equity release. We'll give her money now. And what she can do is basically buy a house with it. And some of these equity release cases come with a lot of, let's say, bells and whistles, okay? Because that particular individual that was helping her daughter, right? Like they were living in a house. I think the house was worth about 2.5 million, something like that. It was, you know, one of those North London houses, you know, what around that part, you know, and within the North Circular, right? And it was around that sort of figure. And what you're able to do with some of these equity release lenders is you're actually able to protect a certain part of the house. So, for example, let's imagine if you just draw a line down the middle of the house and you can do equity release on half of the house. And the other half of the house is basically protected for the other beneficiary. They may never need that money until, you know, they get it in their will or whatever, or until the house is sold. But there is protections in that case as well. So the whole house wouldn't get eaten away, you know.
Really? So in that case, you could split it.
Correct. Yeah.
So that maybe the daughter's getting one lump of money, but the other kids are maybe not getting the same amount. So that's one way of dividing it and protecting the other half of the house.
Yeah.
For the beneficiaries.
Like I've done an equity release quite recently for done equity release for a person who was buying another house. So what they done was they basically was that they done the equity release on the house that they were actually going to buy.
Okay.
And that they had a certain amount of deposit, of course, but once the solicitor, you know, completed on the closing, then they've done the equity release, and that basically then paid for half the house.
Fantastic. So you can actually use it on a purchase then.
You can, yeah. And it's not. I haven't done many on the purchase, but I've done one recently actually, and it was just used for that purpose. That purpose alone.
And do you make sure they've got a will as well? Is that important to have?
A will is very important, but more important than the will actually is having an enduring power of attorney.
Okay.
Or is that what they're called now? Powers of attorney. The cheeky
living will or
Yeah, it's a power of attorney, right? Simply because, yeah, we always recommend it because if you're doing a drawdown situation, some of the drawdown lenders will require 2 signatures to release further funds.
Right.
And if, for example, one of the individuals, if they're, you know, if they're basically not haven't got full mental capacity, then in theory they can't basically sign that form, and therefore that would then hold up the whole equity release, and then you would have to get about the solicitors involved and court of protection involved, and everything. It costs a fort, right?
Yeah, sure.
So what you're better off doing is, I always recommend that they discuss a powers of attorney, both financial and medical, with their solicitor, or if they have another advisor, discuss it with them. So we recommend that you always have one of them in place, especially on the drawdown.
Which I think most people wouldn't have. A lot of people don't even have a will, let alone a living power of attorney. So you're giving them...
I always make it very clear that if something happens to the other individual and they're not able to sign that form, or haven't got capacity to sign the form, then the lender will take forever to sort it out, and it'll go through the lawyers, and it will cost a lot of money just to do it.
Yeah.
To get it resolved.
And how are you finding the market at the moment? Is it getting busier?
Oh yeah, the market is quite buoyant at the minute. Yeah. Okay. Yeah, and what you're finding is that, what I have found is that it's that scenario I spoke about earlier on, where the interest-only mortgages are coming up to time to be repaid.
Right.
And they've actually borrowed more than the equity release provider will give them. So, they have to sell their house eventually.
Because equity basically means the value left in your house after the mortgage. So if you've got a house worth 100,000, your mortgage is 50,000, your equity is 50,000. But with these interest-only mortgages, you said, which they've kind of stopped after the last financial crisis, but people had them from before.
Well, people had them for years. Like I've had them in the 80s. And the scenario is, right, it's not, the scenario is the guy that's the small businessman. That is really what that is it. Where they were on good terms with their bank, or whatever the case might be. The business got into a bit of trouble. What they done was they said, well, we need some cash to keep the whole show on the road. So then we go to the house, we remortgage the house, we take out some money, we put it into the business, and then the business may survive and thrive, or it may fail, as we've seen as well, but they're still lit, and the guy might turn around and say, well, just got to go back and get a job now. But he gets a job, he gets enough money to pay the mortgage, but nobody ever thinks of repaying the mortgage. It's like paying rent, living in the house,
Yeah.
I've seen they're quite common, actually.
I remember in my days in financial services, when you say we haven't got a pension, and they used to say, my business is my pension. I don't need to save in a pension because my business will be sold for a fortune. And of course, you see that it doesn't always happen. Businesses change, the market changes, technology changes. Sometimes their business is worthless.
Well, you're seeing it more and more now, especially with internet. Basically, the internet's the internet. I'm sitting here in the office in my garden. You know what I mean? The internet's changed the world. And what a lot of these guys, if they've had super businesses, but they're maybe one-man band businesses. They really have no value to sell on.
Correct.
It's just a case of them buying a job, and then once they come, what they're going to do, they just retire. And maybe they may have a few tools that they can sell. It's it's the way of the world. And technology has changed everything. So it has.
And do you tend to meet people face to face, or do you do Zoom calls? How do you tend to?
I do whatever.
Okay. You're flexible.
Face to face, telephone. Whenever initially it was all face to face. It was face to face with a family member as well.
Right.
It wasn't just them. It was usually be the daughter or the son-in-law, or the son, or whoever would happen to be there. We always like to have a family member present at the meeting, even if we do Zoom calls. I'm not that familiar as I usually tend to use Skype. That's what I was using. A similar type of idea. And we would have, there would be a bit like this here, there'd be a scenario. There wouldn't be 20 screens or anything. They wouldn't be in different rooms.
Yeah.
They would be just all in the one house, and we'd be sitting in,
be
sitting there, the mom would be sitting over there, and father, and we'd just be discussing how it all works. And what I would do is I would basically take them through. I know we haven't looked at this yet, but this is a presentation, right? And this is like a PowerPoint presentation of what I would do is I would send it off to them first.
Okay.
And then what I would happen to do is then I would phone them and we would go through the PowerPoint presentation, because this basically covers everything, you know. And maybe there's some things I've forgotten about here. Right, that was the home reversion. We would discuss that, and the protected bit about, you know, who's protected in the event. Interest payments, you can make interest payments or you can make no payment. You're not forced to. Interest rate options, mostly all fixed. Repaying your plan, how you can repay it, breakdown of costs. The costs are basically associated with our solicitor's costs, usually around about 600 or 700 quid. Sometimes there'll be an arrangement fee. A lot of the lenders waive that arrangement fee. A lot of them, there's a survey, because there has to be a survey done as well. And what tends to happen is that the lender will pay for the survey, you know, so they don't physically have to pay. So 90% of the time, there is no physical cash transactions at all. You know, there's no fees tend to be either waived or added into the product. But bear in mind, if they're added into the product, interest is going to be charged on that for adding to anything, you know.
And presumably this sounds like an obvious question, but this would only apply to a house that you're living in, your residential. So guys, if you've got a buy-to-let mortgage on interest only and it's expiring, I don't think you can go and do an equity release on a buy-to-let.
You can't do an equity release on it, but what you can do an equity release on is that there's one company that allows you to do them on buy-to-let, but it's a non-encumbered buy-to-let. So just bear that in mind. And also, they would allow you to do it on a holiday home, some of them. But they won't go to like 50%. They usually cap it around 25 to 30%, that type of figure. And that's on the second or holiday home.
So I think obviously it shows that property has been a very good investment for people, because they got something they can fall back on. And I suppose for a lot of people, they think in the old days, you just got one mortgage, one property, you worked and paid it off, and sometimes paid it off early, and you don't want to do anything else. You never want another mortgage because you've had that relief of paying it off. But I think people are starting to think a bit differently now.
Yeah, they are. But they are, because they can see that what they see is the equity that's actually tied up in this house, right? They may have 20 or 30 grand in the bank, but they're living in a thing that's probably, as I said, about £800,000. And most of the people around the 70 age group don't have a mortgage, or whatever mortgage they have is negligible compared to the value of the house. And their kids, man, are struggling. We see it every day. Like I done it myself. I had a property, sold it. We basically just split the money down the middle and give it to the two kids. You know what I mean? And
it does make sense, because a lot of people are in these big houses, but they're not that financially well off. The income's dried up. That they need repairs, or they might want to get solar panels, or they just need to do the roof. And people are, and it's, to me, it makes sense. Okay, if you get over that fact that there's a mortgage, but you know, if somebody dies and then leaves money to the kids, it can take a year or two before the kids even get hold of the money. This is after going through probate. This way, I think you can give it to them now, when they need it, and then, you know, when you die, you've actually reduced the value of your estate if you live.
Just bear that in mind. It is a debt on the estate. It is from day one, you know. And people say, well, what are the tax implications of equity release, right? Well, there really isn't any tax implications of it, because it's a debt on the estate. However, what it does affect, it affects your means tested state benefits. So if you're getting means tested ones, then that would have to be assessed and they would have to be calculated, and that type of thing. But we would, well, any equity release advisor would go through all that at the time. You know, they would ask them about their income. Are they getting pension credit, or are they getting PIP allowance, or life, or life or sickness benefit, or whatever the case might be. And then they would look at whatever the means tested ones are, because some of them it could affect the I was going to call it rates. It shows you how old I am now. I can't remember what
council tax.
Council tax, that's it. Yeah, you know, some of it could maybe affect because you might not. Some people are getting help with their. You
might not qualify. Once you've got this money in the bank, then you effectively you don't qualify for these benefits. But anyway, you go through all of that. But this is very different from just taking out a mortgage where the advisor says, right, you can have a mortgage. You're going through their whole life basically and making sure this product is suitable for them. They're going to benefit from it, because you've got compliance looking over your shoulder as well.
Correct.
Yeah.
We can't move without somebody checking. And you know, and anybody, if somebody comes on and says, well, we can get this all sorted out within the same day, they don't believe them, because the people who nobody wants the liability of a complaint. You know, a complaint, just everything just grinds to a halt. There's tons of paperwork. Then there's arguing with this, and there's solicitors and ombudsmen and all sorts of things. So everything has to be checked, 100%.
And presumably, people must make sure that their advisor is regulated and registered with the FCA,
and preferably with the Equity Release Council as well. You know, you can check me out on the Equity Release Council. You can see my name up there. So, and that's basically the governing body of equity release. You know, we follow all their guidelines.
Okay. Well, I think that's been great. Is there anything else you wanted to add to that? Because I think
I'm just going to
really
do the legal bit. I'm just going to do the legal bit. Whenever you're basically getting equity release, it does reduce the value of your estate. Just make sure that your advisor is qualified, that that's qualified to give the advice. Preferably have a member of the family present when you're actually carrying out the conversation with the advisor. And also, get a personal illustration. That's what I was going to show you. Like this is, which you can't see, but this is a personal illustration. And in that, it basically covers everything to do with the equity release. And a proper, an equity release advisor will take you through it. It's quite a long document. And
it looks quite.
It can take a while to go through it, and it'll take maybe an hour or so to go through this. But it goes through everything, right? Because it talks about moving home, and this is the bit that I mentioned to you earlier on. Can't really see that, but that basically shows you how much is owing at any particular time. So you can look at that and say, well, in 10 years' time, I borrowed £135,000. In 10 years' time, I owe 216,953 quid. That's it. That's basically simple. That is.
And hopefully, to qualify that, the property should have gone up in value as well.
Well, we're not allowed to say that.
I know what you mean.
We're not allowed to say that, but you know that's what tends to happen. Like I've had people that have remortgaged equity release. You know, people that have done equity release for that were actually on the 8%. You know, and what happens is the houses have gone up in value. And they have aged, therefore they've been able to take more out. So what they've been able to do is to remortgage the equity release
with another equity release, or
with the same company, or they could do it with another equity release provider.
Okay, great. So you go through everything with them. You don't just stick this key fact sheet in a brochure and say, "Here, I'll read that." You're going through.
No, we can't do that. I'm afraid. No, because it has to be suitable. The advice has to be suitable, and you know it's all about suitability for the clients, you know. Like if somebody came along to me and they want to do equity release and they had £1 million in the bank or something like that, and they weren't going to, they had no plans for the £1 million, we would just say to them, just use your money in the bank first, you know.
Okay. Well, I think that's covered everything. Unless you've got anything else to add. I mean, we're not recommending equity release here.
No, we're not recommending. This is just an educational video.
Speak to an advisor if you have any queries, or I can put you in touch with James. If you feel that this might benefit you. But other than that, all I can say is thanks very much, James, for spending time with us today. And it's been really enlightening and interesting. I thought I knew everything about it, but I've learned quite a few things today myself. So I probably missed a fair bit of it as well. And that's what means when we're going through it with the client, we go through a fact find, everything, we go through this with it. So everything's covered, you know. And then they also get a suitability report, you know, that they have to sign, and that suitability report would probably go to the kids as well if they wanted to. They can read it and sign it to make sure. And if there's any queries or questions, that comes in. Start to finish process usually takes around about 6 weeks. That's how long it takes to do. Okay, and it sounds like it's all above board, all transparent, and everything's, which is great. I like that. I don't want any shocks and scares. No chance. You know what I mean? Sure. No way. Sure. Okay, well, great. Thanks very much. And if you want another session on us, we can do another session with James maybe in the future. But you can have somebody on that want to do maybe questions and answers, that type of thing, you know. Great. Okay, we'll look at that as well. Thanks very much, James, and I will speak to you again soon. And I hope you found that interesting, folks. I think it's been fascinating. Fantastic. Thanks a lot.